Hi everyone. I've been traveling the world for the last 3 weeks, going via London, New York, Singapore and Hong Kong. So literally the tour of the planet. Couple of observations. First, UK remains challenged. 10 years ago had one of the best relationships with the US, Europe and China. Today it's at its lows. Trump versus Starmer, all-time low. Europe, Brexit. And the meeting between Starmer and Xi Jinping had very lowest moment on all the issue of Hong Kong and Taiwan. So contrary to what has been reported by the media, the relationship is much colder and sour. So I think UK remain challenged, lots of propaganda, but the post-populism out of Brexit will have long-term consequences, which in my view will generate further downside, in particular in the currency. US on fire, but priced. The S&P at 6,000 is at 22.5 times earnings, and the earnings yield, so earnings of the P minus the 10-year yield is negative. It's been negative only twice over the last 30 years. So in my view, there is a bit of a valuation bubble. And most importantly, the 10-year remains challenged because growth will be above 2 to 3%, inflation likely above 2, so it's not clear why the 10-year offers any value at 4.5%. And if the 10-year was to widen, then the multiple of the S&P will shrink. So I think caution here is advised at 6,000 of the S&P. At the same time, very positive appointment of the US administration under Trump of Scott Bessent. I've known Scott since 1998. He's one of the best global macro thinker I ever met. Super smart on markets, follow academia, one of the most prepared person in my view to lead the US Treasury. Great appointment. I think this provides stability, level-headed, maturity in analyzing complex issues. Asia came back more positive on China, in particular in all the new sector. Huawei has transformed, all the tech firm in China doing super well, the EV taking market share and advancing, while China structural sector, the real estate remains under pressure, losses still have to be absorbed, so short-term consumption negative, but long-term positive. At the same time, all the companies that were trying to diversify away from China into India are quickly going back to China, we have been told. So I think in markets, India 22, 25 times earnings vis-a-vis China less than 10. I think there's more value in China than there is in India today across stock markets. It's just not the Adani case, it's much deeper than that. At the same time, I think China can respond to potential tariff with a renminbi devaluation. China has already demonstrated they can borrow in US dollar by basically Saudi Arabia, which in my view has been a key moment in monetary policy. And all this means hopefully that we're going to see some tariffs, but not an outward commercial trade war, which is what somehow has been priced versus China. Singapore and Hong Kong remains, in my view, two great places to deploy capital as they keep on innovating, transforming, adapting, and both of them I found them improved vis-a-vis the last trip I did. Europe remains challenged on the auto sector because of the EV strength Chinese. And I think eventually in Europe we'll have a change in policy, which is going to slow the adoption of EV and electrification because our industry is just not ready. If not, we'll run the risk of just having lots of bankruptcy and nothing else. So I think politicians here will have to take stock with reality rather than dream, and will be a change in adjustments of European policy, which means electrification will be achieved, just will take longer. And that means will allow firms to adjust properly, compete and innovate rather than be forced to be something that they're not. At the same time, as we said, dichotomy in rates, Europe downside, US upside. That means it's already reflected in the euro dollar, which is almost at parity. And the sector that will benefit the most out of all this Trump inflation and printing and deregulation is the financial sector that has been overcurbed by unelected officials that kept on putting new rules and regulation. And so I think positive in particularly for the European financial sector that trades on 5-7 times earnings, its prices growth, And as all the M&A activity of the last couple of months is demonstrating, the CEO themselves are buying companies in the sector. Why? Because they can make deal with 15% plus return on investment that very few sectors can achieve today, and hence we remain positive financials, both equity and credit, with an all-in yield above 10% between dividend, share buyback, and credit instrument.